Ratio analysis, our next topic. Now, what is ratio analysis? We'll do the coverage. What's ratio analysis? Introduction, types or classifications of ratio analysis, and then finally we look at the preparation. So we start with the ratio analysis. What is ratio? Ratio, the word ratio means the quantitative relationship between two or more items. Show one item in terms of another item. In mathematics, ratio means a relationship between two or more numbers of the same kind. So in general, it means the way of consistently showing the relationship between two or more quantities of something. Now, what do you mean by analysis? Analysis is the process of breaking down complex topics or substance into small parts in order to gain better understanding in it. The examination and evaluation of relevant information to select the best course of action from among various alternatives. So analysis is about problem, not solution, about why rather than how, about discovery rather than innovation. Now we come to what is all about ratio analysis. So the meaning: it is the process of determining and interpreting numerical relationship based on the financial statement. Definition: quantitative analysis of information contained in a company's financial statement. So you quantify the information. Quantitative means you give them in figures. Next, significance. Now, what are the significance of ratio analysis? Number one, give meaning to figures. Number two, planning and forecast. You can predict what will happen in the future. Number three, basis of decision making. It's good for decision making. Number four, compare results and performance. You can compare results and performance for different companies, for different nations. Number five, analysis of strength and weakness. So through ratio analysis, you can actually establish the strength and the weakness of your business. Analyzing changes in the form of trend. You can analyze changes in the form of trend. Types of ratio analysis. So the following shows the classifications of ratio analysis. Number one is the liquidity ratio. Number two is the profitability ratio. Number three is the activity ratio. Number four is the leverage ratio. And finally, marketability ratio. So we start with number one, liquidity ratio. What is a liquidity ratio? Type of ratio which shows the ability of the business to pay their short-term debts. The formula. So the types of liquidity ratio, we have current ratio or current asset ratio. 2, we have quick ratio. 3, we have cash ratio. So these are the common and the critical liquidity ratio. Current ratio. What is current ratio? Shows a relationship between current assets and current liabilities. It is used to show the ability of the firm to pay their debts. The ideal ratio for current ratio is 2:1. Formula: current ratio equals to current asset divided by current liabilities. We move to the liquidity ratio or quick ratio. What is quick ratio? It shows a relationship between liquid asset and current liabilities. The liquid asset includes all current assets except stock and prepaid expenses. It's also called absolute or acid test ratio or quick ratio. The ideal ratio for quick ratio is 1:1. One current asset equals to one current liability. Formula: Quick ratio equals to liquid asset divided by current asset. We move to the next one, cash ratio. What is cash ratio? It shows a relationship between absolute assets and current liabilities. The absolute assets include all cash, bank, and any other marketable security. The ideal ratio is less than 1 or 1 is to 2. One current asset equals to 2 current liabilities. The formula: cash ratio equals to absolute asset divided by current liabilities. Profitability ratio. Now this ratio, what is profitability ratio? It is a type of ratio which shows the performance of the business over a given period of time. It helps the users to know where they are and where they will be and how can they get where they are going. Assess the firm ability to earn profit on sales, assets, and equity. So this ratio is normally presented in terms of percentage or times. Types: we have gross profit ratio, we have net profit ratio, we have expenses ratio, we have operation ratio, we have return on capital employed ratio, we have return on investment ratio. So these are the components or types of ratios in liquidity ratio. Number one, net profit ratio. It reflects the relationship between net profit and the sales. Assess the ability of the firm to generate income from its operation. The ideal ratio is the higher the ratio, the better it is, presented in percentage and times. Formula: net profit ratio equals to net profit divided by sales times 100. Number 2, expense ratio. It shows the relationship between expenses and sales. The smaller the ratio, the better it is. The formula: expense ratio divided by sales. Now in expense ratio, there are different types of expenses. Operation ratio. What do you mean by operation ratio? It shows a relationship between operation cost and sales. Now the operation cost includes cost of goods sold and all expenses. The higher the ratio, the worse it is. Formula: operation ratio, operation cost divided by sales times 100. We move to the next one, return on capital employed. What is it? It shows a relationship between net profit before interest and tax and capital employed. It determines the ability of the business to give return out of the fund employed in the business. The higher the ratio, the better it is. The formula: return on capital, so there is a confusion here. Return on capital employed equals to net profit before interest and tax divided by capital employed. Next, return on investment. What is return on investment? It shows the relationship between net profit after tax and capital employed. Assess the ability of the firm to generate income through investment undertaken. The higher the ratio, the better it is. The formula: return on investment, net profit after tax divided by capital employed. Now the question is, how do you get the capital employed? Capital employed is total fixed asset. You add net current assets. How do you get the net current assets? Net current asset equals to current assets minus current liabilities, gives you the capital employed. Return on assets. What do you mean by return on assets? It shows the relationship between net profit after tax, after interest and tax, and total assets. It determines the ability of the business to generate income out of assets invested in the business. The higher the ratio, the better it is. The formula: Return on assets is net profit after tax divided by total assets. Now we come to the activity ratio. This is number 3 type of ratio. What do you mean by activity ratio? The ratio determines the rate at which stock move in and out of business, and at the same time, it states the time taken for debtors and creditors to honor their dues. Types: we have stock turnover ratio, debtors turnover ratio, debtors coverage ratio, creditors turnover ratio, creditors coverage ratio. Now, we start with the first one, which is stock turnover ratio. What do you mean by stock turnover ratio? It is a ratio that shows the relationship between cost of goods sold and average stock. Now, how do you get there? Determining the rate at which the stock move in and out of business. The higher the ratio, the better it is. The formula, cost of goods sold divided by average stock. Now, how do you get the average stock? You say opening stock plus closing stock divided by 2. We move to the next activity ratio. So the next ratio is debtors ratio. The ratio shows the relationship between credit sales and debtors. Determine the rate at which debtors pay their debts. The formula, the higher the ratio, the better it is. The formula is credit sales divided by debtors. Debtors coverage ratio. How do you get the debtors coverage ratio? So the ratio shows the days it takes for debtors to pay their debts. How do you do that? You say 1 divided by debtors turnover ratio times 365 days. But with holidays, remember the days will be reduced. Creditors turnover ratio. Determine the rate at which creditors are paid their credit. The formula is credit purchase divided by creditors. Creditor coverage ratio. Determine the days it takes for creditors to be paid. The formula is 1 divided by creditors turnover ratio times 365 days. Leverage ratio. What do you mean by leverage ratio? The type of ratio which establishes the best source of capital to be used in a company. It gives the composition of capital which is good for running the business. Types: structural ratio and 2 coverage ratio. Formula: structural ratio. They are ratios which determines the structure of capital raised in a business based on the composition of debts and equity in the financial structure of a business. They include the following. 1. Debt ratio. It shows the relationship between debts and capital employed. Formula: debt divided by capital employed. Now our capital employed in this case is debt capital plus equity capital. Number 2, debt equity ratio. Determine the relationship between debts and equity capital. Now this is actually a ratio which gives us the gearing. It's also called gearing ratio. This ratio is normally useful in determining the best source of capital. At what point you change from the external capital to internal capital, from debt capital to equity capital. Formula: D over E. Debt asset ratio. The ratio shows the relationship between debt and assets of the business. Formula: debts divided by assets. Leverage ratio, coverage ratio, that's number 2 ratio. The ratio shows the relationship between debt servicing, commitment, and the source of meeting these burdens. They include the following. 1. Interest coverage ratio. The ratio shows the relationship between net profit before interest and tax and total interest to be paid by the business. Determine the ability of the business to pay their interest. Formula: net profit before tax and interest divided by interest. The higher the ratio, the better it is. That tells you the business is in good position to pay their interest. Fixed charges coverage ratio shows how many times the cash flow before interest and tax covers all fixed financial charges. Formula: net profit before tax and interest divided by interest minus repayment on loans divided by 1 minus tax. Debt servicing coverage ratio. The ratio shows the ability of the financial institution to pay their financial obligation. The formula: net profit before interest and tax divided by interest plus loans, lease rates plus return on total lease. Ideal ratio is normally 1.5 to 2 times. That brings us to the end of the first session of ratios. So we are left with marketability ratio.